Dear students, welcome back. And in this lecture, which is in fact the last lecture, it's a bit a longer lecture. I try to make some of the more abstract concepts and theories a bit more concrete. So I'd like to give you a practical perspective and show you what hedging means in practice and what a writer does in practice. And I'll also say something about these concepts like risk-neutral probability measure. What is a risk-neutral probability measure and how is it used in asset pricing theory? We have seen that the discounted option price is a martingale under the risk-neutral measure, and that is important, of course. But what is it? So here I write a risk-neutral probability is the probability of a future event or state where both trading parties in the market agree upon. That is the basis. Both parties agree upon something to happen. So here's a simple example. Suppose for a future event, say that it rains tomorrow at 12 o'clock, two parties, A and B, they enter into a contract in which party A pays party B €1 if it rains tomorrow at 12 and €0 otherwise if it doesn't. And for such an agreement, there will be a price for B to pay to A. So we have these two parties. Tomorrow, A will pay out B. And for that, today, B has to pay a price to A. If they, for example, agree that B has to pay 40 euro cents to A, this already means that the two parties think that the probability of the event to happen is 40%. Otherwise, they would not have reached that agreement and signed such a contract, an informal contract. So this price, this 40 cents, that reflects the common belief towards the probability that the event happens. Both party A and party B agree on the 40 cents. So both thinks that that's a fair price. 40% is then the risk-neutral probability of the event to happen. So it's not a historical, statistical measure, or it's not a prediction of any kind. It's not a true probability. So one can ask, what kind of information is now offered by this risk-neutral probability? And where can we find this measure in the real world? Well, for this simple example mentioned, so raining tomorrow at 12, once the price is established, 40 cents, then the risk-neutral measure is also determined. And whenever you have a pricing problem in which the event is measurable under this measure, you have to use this measure to avoid arbitrage. If you don't, if you come up with another price, it's like you're simply giving out another price for the same event at the same time. And that is an obvious arbitrage opportunity. I want to give an example of that. And let's stay with the example from before. So we have our party A and our party B from before. And when it rains tomorrow at 12, party A will pay €1 to party B. And for that contract, party B now pays now 40 cents to party A, right? So with that, we just mentioned, with that, the risk-neutral probability is set, is sort of determined. Now, suppose there is another party which gives out another price, party C. And party C says, well, I do it for 30 cents. Yeah, for 30 cents, I pay out €1, you pay me 30 cents. Then party A immediately goes into this contract, pays now 30 cents, and will get, when it rains, will get tomorrow €1. So why is this an arbitrage opportunity? Let's see what happens with party A, for example. Party A took advantage of this different measure. €0.3 was a different measure. So what happens? Basically, we have two possibilities. Either it rains or it doesn't rain, no rain. And we have party A. Why was party A so eager to go into this business? Well, let's first look how it goes with party B. What happens when it rains? Well, party A has received 40 cents and it rains, so party A has to pay €1, so I would have to lose 60 cents to party B when it rains. What happens when it rains in the other side? Well, party A has paid 30 cents. It rains, so we'll receive €1, so we'll receive in total 70 euro cents when it rains. What happens in the case of no rain? In the case of no rain, well, party A has received 40 cents, doesn't have to pay out, there was no rain. So from party B, we'll receive 40 cents. And what happens in the deal with party C? Well, party A has paid 30 cents and we'll get nothing because there's no rain. So lost 30 cents to party C. And in total, you'll see that either when it rains or when it doesn't rain, party A always wins. So there's no risk. And this is an arbitrage opportunity. So if there's another price for the same event, there is a possibility to make a profit. Yeah, there is an opportunity to make a risk-free profit. This is always giving a profit in this case, and that is always risk-free. Now let's assume, let's look at it a little differently. Party A will pay €1 to party B when it rains tomorrow, and for that party B has paid 40 cents to party A. So party B will say, okay, now I will offer 50 cents for the same deal. I will offer 50 cents. And before we had 30 cents in the second deal. Now party B says, I'm in a deal, but I want to do the same deal, but it will cost you 50 cents. And suppose now there's a party D, another party, it says, okay, I want to do that deal for 50 cents. I pay now 50 cents. I pay 50 cents to B, and I will get €1 when it rains. I will get €1 when it rains tomorrow. So on the one hand, party B was in a deal with party A for 40 cents. And then a short while after, party B had more confidence in the raining opportunity. It says for 50 cents, I make the same deal. And party D says, that's interesting for me. Let's again look what that means to party B. So we have party B, we have two scenarios, rain and no rain as before. And now we look at party B. Well, in the case of rain, party B has paid 40 cents and will get €1. So for party B, that is 60 cents plus in the deal with party A. And when it rains, party B has to pay out to party D and will lose 50 cents to party D. No rain, in the case of no rain, 40 cents have been paid, nothing has been received, and 50 cents has been received, and nothing has been paid out in the case of no rain. So again, you see that when, in this case, party B is smart in a way and was in an uncertain deal, right? And in this case is in a deal where there's a guaranteed profit. Whereas, of course, if we look at the standard setting, there is, of course, gains and losses, right? So if we have rain and no rain, rain and no rain, and we look at party A and we look at party B, here we just have a unique measure. And it is really like a gamble for tomorrow. And in the case of rain, A will lose 60 cents. And in the case of no rain, A will win 40 cents. And B is just the other way around, right? This doesn't matter now. In the case of rain, B will receive 60 cents. And in the case of no rain, B will lose 40 cents. So this is a very basic example where a trade has been agreed upon and somebody else comes with a slightly different trade, and then one of the other market parties can benefit from this. And the benefit that we just saw, you are in a deal with 40 cents and then you try to make a deal yourself with 50 cents. That is a very common deal in the market. A trader being in different constructions, selling contract and buying contracts, and always try to end up with a little profit in this matter. So that is the notion of risk neutral probability. You agree upon something which happens in the future. Here is another arbitrage opportunity. So arbitrage means that without risk, it is possible to make a profit that is larger than putting money on a bank account. And no arbitrage typically, so no arbitrage, that is like a fair game. That is like an example of a fair game that says there's never an opportunity to make a risk-free profit that gives a greater return than putting money on a bank account. Now let's look at this example. We have a portfolio with a put where we were selling a call. We bought a put, we were selling a call at time t, and we were buying the stock. Yeah, and the put and the call have the same expiry date and the same strike price. Now, what is a fair price for this portfolio? And what is now a fair price for this portfolio? Immediately, you wouldn't know the answer, I think. So what is the fair price of this portfolio? Now, let's look at this from the perspective of arbitrage. And that is by means of the put-call parity relation. So there is a relation in the market that should be satisfied. Otherwise, there's an arbitrage opportunity. So let's look at these two options, C, the call, and P, the put, European call and European put option, the same strike price K, and the same expiry time capital T. And suppose we have these two portfolios, portfolio A and portfolio B, at time t equals 0. And portfolio A consists of the call option plus cash, K e to the power minus RT cash. So that is a call plus cash, a call plus cash. That is portfolio A at time 0. And portfolio B consists of a put plus the unit of the asset. So S0 and P0. All right, that is the setting that we are now in. Let's look at these portfolios at final time. At final time, we have a call option. So call option will have at final time the maximum of S minus K and 0. And at final time, K e to the power minus RT will be equal to K, right? That is when the money grows exponentially, and we have this initially on our bank account, then at final time, at time capital T, we will have K on our bank account. So portfolio A at final time capital T will be the maximum of S and K. That is what this gives us. Let's look at portfolio B. One put option, that is at final time the maximum of K minus S and 0, and 1 unit of the asset plus the stock at final time. So if we look at that portfolio at final time, it is the maximum of K and S. So these two portfolios have the same payoff at final time. Then no arbitrage tells us that they should have the same value at any time prior to the final time. They should be the same. Otherwise, you can buy one, sell the other. In the end, they are worth the same. So if one is worth more than the other at an earlier time, you can make an arbitrage opportunity. You can buy the cheaper one, sell the more expensive one, and in the end, you do the reverse action and you end up with a profit. So here again, what I've just done, what I've just told you, at expiry, portfolio A is worth the maximum of S and K, and the same for portfolio B. It's worth the maximum of K and S. So in principle, we know that at any time little t, the call plus cash at time little t, it's K times e to the power minus R capital T minus small t, is equal to a put plus a unit of the asset, is equal to the put plus a unit of the asset. So if we look at this, then we see that this should hold at any time t. Otherwise, there is this arbitrage opportunity. And if we look at this, we see that the value of the put plus the value of the stock minus the value of the call should be equal to K e to the power minus R t minus t. And this is in fact an answer on the question from the previous slide. Let's look at the previous slide. We had a put minus a call plus the stock. And we ask ourselves, what is the fair price of this portfolio? And we have just seen that the fair price, the put plus the stock minus the call, is K e to the power minus R capital T minus small t. Because when this is violated, again, you can buy the cheaper one, sell the more expensive one. In the end, they are worth the same. So you do the reverse action. That doesn't cost you anything. That doesn't bring you anything. So what remains is that little difference, the expensive one minus the cheaper one, that little difference that remains as a profit in your portfolio. And this is the put call parity. And what is important here also is that we didn't make any assumption about the stock. Right? We didn't make any assumption about the stock dynamics. We didn't say geometric Brownian motion or whatever. This is just a relation between put prices and call prices in the market. And when this relation is violated, then there will be traders in the market. They are called arbitrageurs. And they will find this opportunity and buy a lot from the cheaper one, sell a lot from the more expensive one, and in the end, revert it back. Now, arbitrageurs, that is nowadays, these are more like computers finding this, right? Algorithms finding this. We don't need these people anymore to look at this carefully, except when there are very deep insights needed. Of course, then we have traders looking into this, but often it is just computers looking at these arbitrage opportunities. Okay, now I want to say something about hedging. And for that, I will look again at the Ito-Dublin formula. And in many textbooks, this is also called Ito's lemma. Again, that's a little confusing. I don't want to confuse you, but you will see a lot of Ito's lemma. And Ito's lemma basically helps in deriving solutions to stochastic differential equations, right? So it is as follows. Again, try to connect it to the Ito-Dublin formula. When we have S, stock S, follow, in this case, we call it S, stock S following an Ito process. DST is some drift term mu bar, depending on T and S dt, plus a diffusion term sigma bar, again, depending on T and S dWt. We will use a short notation that mu, which depends on T and S, we will just call it mu bar of T. And a sigma bar of T, that will denote sigma bar, which depends on T, but also on S. Now let's have a function G, depending on T and S. And we call yt, that is the stochastic process, which is G, depending on T and ST. Well, then the important insight in Ito's lemma is if we look at the dynamics of Y, the change in Y, dyt, that is equal to the following: dg dt plus mu bar t dg ds plus 1/2 sigma bar square t, the second derivative of g with respect to s, dt, plus sigma bar dg ds dw. So the important notion here, the important saying from Ito's lemma is that if we are dealing with an Ito process where the dynamics depends on partly on dt and partly on dwt, and we look at the dynamics of the function, then we have a function y depending on t and s. And if we look at the dynamics of the function, it is essentially the same. These are essentially the same dynamics as the original process, in the sense that we have a term in front of a dt and we have another term in front of the dw. So essentially these two processes, S and Y, they are driven by the same by the same uncertainty, dwt, and they have a drift term, both have a drift term and dt term. Of course, the term in front is different, mu bar here, sigma bar here, and here we have sigma bar times dg dv, and here we have this longer term, and here you recognize from the Ito Dublin, we had ft, and we had fx, and we had fxx, and here we have something like sigma square dt, that was something like dw or ds, if you remember. So this is all the same, it's just a little different notation, and it's very handy to work with this. And the important insight is, in fact, that again, these two processes are driven by the same dynamics, a dt term and a dw term. So in a clever combination of these two, we can try to remove the uncertainty, and the uncertainty is hidden in the dwt term. I want to eliminate randomness. Again, this is Ito's lemma, so the Ito Dublin formula. dgt, the change in this function, the function which depends on t and st, is then mu bar dg ds plus 1/2 sigma bar squared, the second derivative of g with respect to s, plus dg dt dt, plus sigma bar dg ds dw. That is Ito's lemma. Now, as I just mentioned, the random walk in S and G, they are essentially driven by the same random variable dwt. Here we have the dwt, and for the geometric Brownian motion, we also know that we have a dwt term. And then comes the important insight that with another variable, h t being equal to gt minus delta t st, and delta is indeed the number of stocks, so delta is the delta from before. We can look at the change in h, and we can try to make that deterministic in a short period of time. Yeah. So delta t is assumed to be a known constant in time dt. So let's look at the dynamics dht. Of course, that is, we have this here, that is dgt plus delta t dst. And then we substitute for dgt, we substitute this expression, mu bar t dg ds plus 1/2 sigma square second derivative plus dg dt dt plus sigma bar dg ds dwt minus delta times ds, and ds is mu t dt plus sigma bar t dwt. And remember that these are functions which also depend on s. Like we did before, we can collect the dt terms and we can collect the dw terms. Here is the dw term, and here's the dw term with the delta. And now if we choose delta being dg ds, by choosing delta is dg ds, then these terms cancel out. So the dwt coefficient vanishes. So in a very tiny period of time, in a dt period of time, there is no uncertainty in this, under these model assumptions. Those two cancel out. And in that very tiny period of time, it's only driven by dt. It's only driven by dt. And that is, in fact, the basis of the Black-Scholes model and the basis of hedging. Again, we start with the assumption that we have our geometric Brownian motion price process. ds over s is alpha dt plus sigma dw. And we have a bank account that grows like with the amount, with the interest, and with the time period. dmt over mt is r dt. Now we define c, depending on t and st. It's the value of the call option at any time, little t. And we consider a trading strategy where one holds one option and continuously trades in the stock. So we start to have this H, G, and S. So we start to do something like this. And now we say this is a portfolio. This is our option. And we have delta stocks. So let's repeat the exercise from the previous slide with the H, but now have a specific portfolio for H, the call option for G, and delta stocks to compensate it. So we look at the following portfolio. Suppose a portfolio which consists of the value of the call option minus delta times the value of the stocks. So this can be the portfolio of a writer. A writer has sold the option and then received the money for the option, the value of the option, has received that money and then buys delta stocks. So that money is reduced by the value of delta stocks. So we just repeat the whole argument with H and G. We repeat it with the portfolio and the call option. The change in portfolio is the change in the call option minus delta times the change in the stock price. Now the change in the call option, remember this is our G of T and ST. So we use Ito's lemma or the Ito-Dublin formula. It's alpha S dc ds plus dc dt plus 1/2 sigma square S square, the second derivative of C with respect to S dt plus sigma S dc ds dwt. And now we look at the change in this portfolio. The change in portfolio is the change in call option and time minus delta times the change in asset price. So if we substitute everything here, we have the change in call option, which we have just derived, this term plus the red term, and then minus delta times alpha STDT plus sigma STDWT. And now the important notion comes that here is the delta. When we choose for delta dCDS, when we choose for delta dCDS, then this term will cancel out with this term. The randomness disappears in a tiny period of time dt. And this also tells us how many stocks we should have in a portfolio as a writer. dCDS stocks, the first derivative of the option value with respect to the stock price, that is the amount that gives us an indication of the amount of stocks that should be kept when we sell an option. And we are under the Black-Scholes dynamics. So this one cancels out. For delta, we choose dCDS. And then we have a dt term here. And moreover, so when we are doing that, we only have dt terms here. The first one is just this one. The second one is this part here, dc ds, that's the delta, times alpha st dt. So that is this term here. And we only have dt terms here. There's no randomness, there's no dw term anymore. So it is instantaneously risk-free. It's instantaneously free of the uncertainty under these model dynamics. Then this cannot be worth more than just putting money on a bank account. So the change in this portfolio should be equal to putting money on a bank account because it's only dt driven. There's no dw, there's no risk anymore. So this should grow with R, it should grow with the portfolio itself, and it should grow with the time instance dt. Now remember that the portfolio was the call option minus delta stocks, and that is in fact now the call option minus dc ds stocks, right? Because we have this over here. So we can also substitute that over there. And so we will have something like this. We will substitute that notion that the portfolio is C minus dCds times S. And if we do that all, then we finally find indeed the Black-Scholes equation or the Black-Scholes-Merton equation, dC dt plus 1/2 sigma square S square, the second derivative of C with respect to S square, plus Rs dC ds minus Rc is equal to 0, of course, plus the call payoff. So we have a final condition, and with this we can work our way back. And this is exactly the Black-Scholes-Merton equation as we have seen it in a previous video lecture. Let's never forget that we are dealing with assumptions. First important assumption, the asset price process ST follows the log normal random walk. So we assume that in the future time period, the stock will follow dst is alpha st dt plus sigma st dw. For alpha, we should think about the growth rate in the future, but particularly for sigma, we should look at the uncertainty in the future. Alpha, we don't care so much because we are hedging, so we are not so sensitive to the growth rate of the stock in the future because we're hedging with the stock itself. So when the one goes up, then we have made a portfolio so that this is not at all sensitive. But the volatility in the future, that is a big uncertainty, of course. We don't know it. Whenever there would be bad news in the future, there would be some change in this volatility. And that is indeed, that is the weak spot in the whole option pricing dynamics. And if we look at more modern models, so if we look at computational finance, which we start as a master course in Utrecht next year, in computational finance, we will do a lot to improve our modeling of this volatility. Well, another assumption that is the interest rate and the volatility are assumed to be constant or known functions of time, but we are looking at these values for the future, and we don't know them. Transaction costs for hedging are not included. So we are always changing this delta. Every time we need to change the delta because delta, remember, delta t is dc ds at some time t. So that changes all the time. The first derivative with respect to the option value, that is an indication for the number of stocks that we should keep in our portfolio as a writer of the option. But we do that all the time. All the dt, we buy and we sell. So delta changes all the time. We buy and sell stocks all the time. And we have not yet included transaction costs for it. We assume that this does not cost anything. There was no dividend paid during the life of the option. There are no arbitrage opportunities. We said that the change in this pi t was equal to r pi t dt. And that essentially says there are no arbitrage opportunities. When we have something which doesn't have risk, then it should grow with dt. And then if we do all of that, we ended up with the Black-Scholes partial differential equation for a European option, and it's a parabolic partial differential equation. Important quantities are the hedge parameters. So for an option writer, so the delta is maybe more important than the price itself, because the delta tells a writer how many stocks he or she should buy in a portfolio in order to compensate all the risk at final time. So delta depends on S and T. It reflects the rate of change of the value of the option, right? dC ds is the rate of change of the value of the option. Yeah. With respect to S. And then the largest random component of a portfolio is in fact eliminated by making this choice. The DWT terms disappear. And it indicates the number of stocks that should be kept with each option issued in order to cope with a loss in the case of exercise. And I will show a hedge experiment just after this. Then, of course, another important indicator, another sensitivity that is important for an option writer is gamma. And gamma indicates the rate of change in delta. So the change in delta, d delta ds, that is in fact the second derivative of the option price with respect to the stock price. That is gamma. Why is this important? Well, first of all, when gamma is small, it basically means that delta is relatively stable. Remember that a first derivative is always a sensitivity. When a first derivative is high, then the change in when the stock price changes, then this will have a huge effect on the option value when this is big. Yeah. When S changes a little bit and delta is big, then this has a huge impact on the value of the option. Now the sensitivity tells us something like the stability of delta. Remember, we are in a portfolio C minus delta S, portfolio C minus delta S. If gamma is low, it tells us that this is a relatively stable number. Yeah, that's not so sensitive with respect to changes in the stock price. So when the stock changes a little bit, then this delta stays more or less the same. That is what gamma indicates when gamma is small. Yeah? And it also implies for the writer that it's only necessary to sometimes change the portfolio. Whereas when the gamma is high, then the portfolio under consideration results only for a very short period of time in a riskless scenario. When gamma is big, we know that there will be something changing. When the stock price changes, this has a huge impact on delta. And that means that the writer should buy or sell stocks immediately. So these derivatives are very important for a writer because they tell something about keeping the portfolio stable. And there are several other important hedge parameters. Now, this is a repetition of previous lectures. Of course, we know the value of the option. We have seen it based on the risk neutral. We have seen it based on the discounted expectation under the risk neutral measure. And we saw that the value of the call option is S times ND1, where N is the cumulative normal distribution function, ND1, where D1 is here a parameter. It's the upper boundary of the integration. D1 is the log S over K plus R plus sigma square over 2 capital T minus little t divided by sigma times the square root of capital T minus small t minus K e to the power minus R capital T minus small t and D2. And D2 is the one with the minus sign here. That we have discussed in detail in a previous lecture. What I want to tell you is if we have this, it's also relatively easy to compute DCDS. Yeah, it's maybe not very trivial because S is hidden here in the argument and S is here, but it is possible with the chain rule and the product rule to find the expression for DCDS. And the same for the second derivative, DCDS squared. And remember that this is delta and this is gamma. And this is delta, this also really reflects the number of stocks that should be kept in a portfolio, that should be computed. And with the put call parity that we have just discussed, it's also possible to find the solution for the put option. If we have this as the call option, and we have this relation between the put plus the stock minus the call is equal to k e to the power minus rt minus t. And that was the put-call parity relation. With that, we can substitute for the call, we can substitute the put, and then we end up with the value for the put option is k e to the power minus r capital T minus small t n with argument minus d2 minus s times n with argument minus d1. That is then the value of the put option. And particularly, of course, when little t goes to capital T, for both, for this one and for this one, when little t goes to capital T, the put and the call should converge to their payoffs. K minus S, the maximum of K minus S and 0, and the maximum of S minus K and 0. We can take the derivative of the option value, and then we get the delta. dc, ds, if we do that diligently, it will end up being n with argument d1. And for the put, it would be n d1 minus 1. That is the delta of the European put option. And d1 is the term with the plus sign over here. So we have it. That is important. We have these under Black-Scholes dynamics. Under Black-Scholes dynamics, we have these also in closed form. Now let's look at hedging in discrete time. So hedging is done by the writer. And again, it's done in discrete time, and it goes as follows. We have the change in portfolio at time point ti, the change in portfolio, and that portfolio is A sub I, so the number of stocks at time point I, ti, A sub I, times the change in stock price, plus the change in money, and money is R di delta t. Yeah, so suppose we have cash D, change in money is then R di delta t. So the new portfolio is the old portfolio plus delta pi, that is A I S, the value of the stock at the new time point, plus 1 plus R delta t times di. So updating of the portfolio is done by looking what is the new number of stocks that we should keep in our portfolio, and then we change the cash accordingly. Yeah, the new cash accordingly. There will be no new money entering the system, and cash also won't disappear. So we look at the following equation. The portfolio at the new time point is the new number of stocks, A sub I plus 1 times the value of the stock, S at Ti plus 1, plus the cash at I plus 1. And that tells us that the cash at I plus 1 is in fact, if we compare this one with this one, the cash at I plus 1 is 1 plus R delta T times the cash at time Ti, plus A sub I minus A sub I plus 1 times the stock value at time Ti plus 1. So how does this go mathematically? So we have our timeline. Suppose we are in a Black-Scholes environment. We have a discrete time axis. It starts at 0, it ends at t. And we have splitted it into equidistant time intervals. At time 0, we have computed the option value C0, and we can compute A0 being dC0 ds. The cash, initial cash is, for example, 1. It doesn't really matter. It scales out. And our initial portfolio as a writer is pi 0 at time 0. It's A0 S0 plus D0. Then we have a loop over all these time points. we know the new stock price. In our mathematical setting, the new stock price is the old stock price times e to the power alpha minus 1/2 sigma squared dt plus the square root of dt times sigma times xi1, and xi is an n01 draw, like we did it in the practical experiment. With that, we have our new asset price. We look at our new portfolio at time I plus 1. It consists of AI stocks with the new stock price SI plus 1, and we have the cash which gained interest, 1 plus R delta T times DI. Then we compute the new number of stocks that we need in our portfolio. That is DC I plus 1 DS, right? DCDS at the new time point, that reflects the new number of stocks in our portfolio. Then we adapt the cash at the new time point. The cash at the new time point is the cash that we just had, 1 plus R delta T times DI, plus the change in the number of stocks, A sub I minus A sub I plus 1 times the stock value at the new time point. And we do that repeatedly. So we go again, we step one time point further, we draw a new random draw, and we look at our portfolio and we adapt this. Now, when we adapt this with infinitesimal small time intervals, we will get to the fair price of the option, right? We get the fair price of the option, which was continuous hedging. So we won't make a mistake. And we have indeed that the amount of cash that we have in our portfolio is sufficient to, in fact, to do this hedging. Because that is the whole purpose. So the whole purpose is the writer changes all the time, changes the portfolio, changes the number of stocks, adapts the number of cash. Every time point changes this so that in the end, when the holder decides to exercise, there will be a stock, then A will be 1 if the stock needs to be sold. When there's no exercise, then of course at some point A will be equal to 0. Let's look at a true experiment. So we have a dynamic hedge for a call under the Black-Scholes model done by the writer. Under the Black-Scholes model, we choose an asset price model with parameters S0 is 1, R is 0.1, and sigma is 0.2. Final time of the option, capital T, is 1, and the strike is 0.95. So we have the initial value is 1, and K is 0.95. We look at a call, so it's the maximum of S minus K and 0. When we are above 0.95, we will be in the money, and otherwise we will be out of the money. We have a time grid. We have a stock which is simulated with this Monte Carlo simulation with the discretization. And based on these paths, based on these stock price paths, we perform the hedging strategy. Now I show 3 paths, ST. One of them would be in the money. So would be in the money means that its intrinsic value at final time is positive. There will be exercise. One ends out of the money. So that is one that will not be exercised. And one will be at the money, close to K. So we will show 3 graphs. We will show the delta, that is the green line. However, when the stock gives a call price, which is the pink line, which is deep in or deep out of the money, then delta will be either 1 or 0. Let's look at them. Here we have 3 pictures. Let's first focus on the first picture. Here is a 0.95. And the stock price is the blue one. You see the blue one, it's doing very well. And in the end, it is in the money, right? ST minus K is positive, which also means that the writer should sell the stock for K. Now the writer receives money. Now here you see the stock price, here you see the stock price, and you see that it will be in the money at final time. So there will be an exercise. So S is larger than K here. So the holder will exercise, which means that the writer should deliver the stock and receive K. Now the writer receives the money, and then the writer will buy delta stocks. And in the beginning, delta is something like 0.6. That is the green value here. And you'll see that at some point when the option gets, when the stock price gets high and the option will be in the money, you see that at some point delta will be equal to 1, which means that the writer of the option will always have one stock in the portfolio. So here at the end point, when the holder decides to exercise, the writer just has the stock, delta is 1, delta stocks, has the stock. He or she will receive K, and with K here, it means that the profit and loss will be equal to 0. It's the fair price. The stock is delivered, and the obligations can be fulfilled. Now in this one, in this second scenario, the stock value starts at 1. It starts in the money, you know, it starts bigger and bigger. So that you see that in the green line, the delta gets to 1. So the stock is there in the portfolio of the writer. Then the stock starts to decrease and decrease. And at some point, it is not in the money anymore. It's out of the money. The option is worth nothing because it is lower than K. It's worth nothing. And you see that back in the delta. The delta goes to 0. So the option writer will sell a lot of stock, until at final time, the option writer has no stock in the portfolio because delta is 0, delta stock are in the portfolio, and the cash, the profit and loss, the cash will increase over time in the last part because the stock is sold. That gives money to the portfolio, and in the end, the portfolio is again 0 because it's the fair price. So you see, because the stock price lands below the strike price, there is no stock needed in the portfolio of the writer. Delta is equal to 0, and that goes naturally with the discrete hedging strategy. And then the cash changes accordingly, and in the end, there's no cash. There's no stock in the portfolio anymore. So it is the fair price and the option is not exercised. Here we see a third scenario. In that scenario, we see that the stock price is wiggling around the strike price K. Then it is below the strike price, then it is above, then below, then above. And also that is reflected in the delta, of course, because if the option is in the money when we are above the strike price, we would need the delta stocks. When we are below, then we would not need the stock because there's no exercise, etc. And that you see also in the delta. And the delta here starts close to 1, and then it gets to 1 because the stock value is pretty much above the strike price. Then it goes down, and then the stock price goes up again. So then also the delta goes up. The number of stocks in the portfolio go up. And then the number of stocks go down because the stock price goes below the strike. And then it goes up again. So then also the option writer needs to buy extra stock. And in the end, it is out of the money. It's not worth anything. And therefore, there is no stock finally in the portfolio of the writer. But I can imagine that this is very stable. So the gamma, the second derivative of the option value, or the first derivative of delta, that will be very stable. And that is an indication that the writer doesn't need to check the portfolio that often. It will be stable. There's not much change needed. Here also there's a period where it's pretty stable. Here you see big changes. So gamma will be huge. And that means that a writer should pay attention and that the writer should change so that the portfolio is instantaneously risk neutral. So this gives you a notion of hedging. So you really see that the delta hedging, you see that the portfolio of the writer adaptively changes so that at the final time, the obligations can be fulfilled. This is again the fair price. So if C is the fair price, then you put a little extra, a premium for risk, any risk, and that, of course, that is not affected by the hedging. So that is a pure profit. If this is enough to do the delta hedging, then this extra that a trader, a writer puts on top of the fair value, that is then surviving this whole process, and that is the true profit of the option. Well, this concludes today's lecture. I thank you for your attention.